It's happening. Mortgage rates have finally started to drop, with the 30-year fixed-rate mortgage rate falling to below 7% from being at 7.79% at the end of October. Now, some people believe that this is great news for the housing market as it will lower the cost of mortgages and increase the demand for homes. However, things are not as simple as this. The Case-Shiller Home Price Index shows that the housing market continues to scream higher, making new all-time highs each month. We are now so far above the trend line of historically normal home price growth that it makes it very hard to imagine how much longer this growth can keep going on for without a correction. Now, this recent drop in mortgage rates has largely been caused by inflation cooling off slightly, falling below expectations in the latest figures, as well as the Fed holding interest rates where they are in the latest FOMC meeting instead of hiking them again. However, even though there are now talks of potential interest rate cuts towards the back end of 2024, inflation is still not fully under control and below the 2% government target, meaning that the Fed is likely to be very cautious around making rate cuts. And Redfin forecasts that mortgage rates will remain high throughout the whole of 2024, ultimately only seeing a gradual fall to 6.6% by the end of next year. This is not too much lower than where we are right now and means that there is little room left for housing affordability to improve any further from mortgage rates alone. And when we consider just how unaffordable housing has become when mortgage rates were slightly higher, I don't think a relatively small decline in average mortgage rates is going to move the needle much on housing affordability. The national payment to income ratio hit 40.5% not too long ago, highs that have not been seen since the 1980s and eclipsing the peak that was seen during the global financial crisis. And this means that the average home buyer needs to be earning $115,000 a year in order to afford a median-priced home, which has spiked by more than 50% over the last 3 years. And this is even more problematic considering the fact that the median household income in the US is $75,000, meaning that there is a big gap between what the average person earns and what the average home will cost you. But another reason why interest rates are being halted and could potentially start to fall in 2024 is because the economy is struggling a lot right now and it's looking like a recession is on the horizon. Looking at this chart of historic interest rates, we can see that throughout the whole of history, rate cuts tend to be a signal that the economy is about to turn south. Looking at all of the periods of recession shaded in grey on the chart, we can see that in almost all cases they came straight after interest rates were cut. And we know that right now in the economy, the labour market is softening as we're seeing job openings fall, average work weeks getting smaller, and bankruptcies and layoffs starting to rise as well. Throughout history, we have also seen unemployment correlate with interest rates, meaning that as interest rates have increased, the unemployment rate has also increased, just lagging behind by a few years. Unemployment is currently extremely low, however it has been almost 1 full year since the Fed started hiking interest rates at a record-breaking pace. Based on this historic correlation between these two metrics, I would definitely expect the unemployment rate to start to rise at a noticeable pace in 2024 and especially in 2025 as well. Obviously, if we do indeed see this happen, then there would be more unemployed people, average wages would be lower, and there would be fewer people who are in the financial position to buy a home. With more people being laid off and made unemployed, we're also likely to see housing foreclosures increase as well. And in fact, we are already starting to see housing foreclosures increase, with foreclosure starts spiking up 30.4% last month to the highest that we've seen in 18 months. And more seriously, delinquencies are also rising at an alarming rate too, particularly for multi-family housing units, which are now at the highest delinquency rate since the global financial crisis. As interest rates start to gradually fall, we could also see an influx of housing supply hitting the market from homeowners who have felt trapped recently in their current home because of the low mortgage rate that they are locked into. Now, most homeowners have a much lower interest rate on their mortgage compared to the current market rate of around 7%. So if this gap between these interest rates gets smaller for current homeowners, then we're likely to see more home sales take place. Now, this is definitely something that has been holding a lot of people back from selling their home and has contributed to a constricted supply on the market, as well as the number of home sales taking place also being at historic lows. Although many of these sellers will likely also be buying another property, this pattern in home ownership is likely to negatively affect the bottom end of the market. This is because many of those who have been desperately waiting for mortgage rates to fall before they move are doing so because they need to upsize their home. This includes families who now have more kids and need to buy a house with more bedrooms, or simply those who want to upgrade from their starter home to something that is a bit bigger and nicer. The entry-level home section of the market could therefore see a surge in supply hitting the market, with there not being enough demand to match it from first-time buyers due to homes still being extremely unaffordable for many people right now. Renting is also a valid alternative that many may choose to turn to instead of buying another home in the current market. Now, surging home prices and mortgage rates has meant that the average cost of home ownership has increased at a much quicker rate than the average rent has increased, meaning that in many cases it is now actually cheaper to rent compared to buy in many areas of the US. And despite the rental market not appreciating at anywhere near the speed of the cost of home ownership, it looks like it won't be picking up any momentum anytime soon, and if anything, it is likely to continue to fall. This is partly due to there being more apartments on the market, but also as a result of the building boom that has taken place in recent years. Now, home builders have had access to cheap and easy capital thanks to the historically low interest rates, allowing them to get construction and developments underway quicker and more easily as well. The median US asking rent declined by 2.1% year over year in November and is now under the $2,000 threshold at $1,967. Now, this is the largest annual drop that we have seen in rent since February of 2020 at the onset of the global pandemic. And of course, shrinking rent prices means a declining return on investment for investors, which makes owning rental properties less attractive compared to other assets like bonds and dividend stocks that offer a similar yield. This is likely to lead to an increase in property sales coming from landlords who are selling up and moving their money elsewhere, as well as less demand from new investors, which will all add downwards pressure to home prices. And to add fuel to the fire of all of this, home builders are currently sitting on large inventory pipelines from developments that were started years ago, meaning that a tidal wave of supply could be hitting the housing market in 2024 and 2025. Now, there has never been more housing units under construction across all of history than there has been in 2022 and 2023, and today the number sits at a staggering 1.67 million units. For context, this number of units under construction was at just 1.17 million pre-pandemic in December 2019, which is a whole 500,000 less compared to today. And this also comfortably beats the peak number of housing units under construction during the height of the global financial crisis at 1.42 million units. This is an alarming volume of supply that is ready and waiting to be offloaded by home builders in the coming years as the construction on these units does get finished. And what is also interesting is that the majority of these units under construction are multi-family units rather than single-family units, suggesting that the units being built today on average will have a higher number of occupants compared to in the past. The housing market is unfortunately just one area of the economy that looks to have a lot of pain ahead of it, and in fact there are a number of scary signals that are pointing to a deep recession across the wider economy, or potentially to something even worse than that. I cover this in more detail in my previous video, which you can check out on the screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot. And apart from that, thanks a lot for watching.